Welcome back to CMA USA Exam Coach, your trusted study companion for mastering the CMA USA syllabus. In today's episode, we're diving into an important topic from international finance, foreign exchange risk. So, what exactly is foreign exchange risk? Well, when a company deals with international business, like exporting goods, importing materials, or investing overseas, it often has to deal with foreign currencies. Now, the value of these foreign currencies doesn't stay fixed. Exchange rates keep changing, sometimes daily, even hourly. This creates a risk, because a payment or receipt that was planned in one currency might suddenly become more expensive or less valuable due to exchange rate fluctuations. For example, imagine an Indian company expects to receive 100,000 US dollars next month. If the exchange rate changes, the actual amount of rupees it receives might be less than expected, or more. That difference can affect profits. This uncertainty is what we call foreign exchange risk. In this episode, we'll break down the different types of currency risks, give you real-life examples, and show you how businesses manage this risk through various techniques. Let's get started. Foreign exchange risk is a major concern for companies dealing across borders, but the good news is it can be effectively managed or hedged. Let's explore some practical methods companies use to hedge this risk. First, we have natural hedges. This means avoiding unnecessary multi-currency exposure by trying to match your inflows and outflows in the same currency. For example, if you're earning revenue in euros, try to keep your expenses, payables, and loans also in euros. This way, fluctuations in exchange rates won't have much effect on your profitability, because the cash in and cash out is in the same currency. Second, we have operational hedges. This involves structuring your operations to stay within the same region. Let's say your major customers are based in China. Instead of manufacturing in a different country and dealing with currency conversion, you could manufacture the product in China itself, using local labor and materials. This localizes both revenue and cost in the same currency, minimizing foreign exchange exposure. Third, companies can use international financing. This means raising funds from the country where you actually need to invest or operate. So, if you're expanding in Japan, you might raise capital locally in Japanese yen, rather than bringing in dollars or euros and dealing with conversion risks. Finally, we have foreign currency derivatives. These are financial instruments specifically designed to manage or hedge currency risk. The most common types include currency forwards, which are private agreements to exchange currencies at a fixed rate on a future date. Currency futures, similar to forwards, but traded on organized exchanges. Currency swaps, where two parties exchange currencies for a period and agree to reverse the exchange later. And currency options, which give the right, but not the obligation, to exchange currency at a set rate. In episode 17, when we covered derivatives, we learned about four major types: forwards, futures, swaps, and options. And we discussed them in the context of commodities, like oil or wheat. Now, in this topic, we're looking at the exact same derivative tools, but instead of commodities, the underlying asset is currency. So what's the difference? Actually, there's no fundamental difference in the instrument itself. Only the underlying asset changes. In this case, we're dealing with foreign currencies rather than physical goods. The objective remains the same: to hedge against price, or in this case, exchange rate fluctuations. Let's quickly review what each of these currency derivatives means in this context. Currency forwards are customized agreements between two parties to buy or sell a specific amount of currency at a fixed exchange rate on a future date. Since they are tailor-made, they are traded over the counter, not on an exchange. These are commonly used by businesses to lock in exchange rates and avoid surprises. Currency futures work similarly, but the contract is standardized and traded on regulated exchanges. That means you can't customize them, but they offer better liquidity and less counterparty risk. They're often used by financial institutions or investors speculating on currency movements. Currency swaps involve two parties exchanging a set amount of currency today and agreeing to reverse that exchange in the future. These are particularly useful when a company needs to raise funds in one currency while servicing debt or making payments in another. And currency options give the buyer the right, but not the obligation, to exchange currency at a predetermined rate on or before a specified date. This is helpful for companies that want protection against unfavorable currency movements, but also want the flexibility to benefit if the market moves in their favor. So to summarize, these derivative tools are exactly the same as we discussed earlier, but now they're being applied in the context of foreign currency exchange rate risk, not commodity prices. Let's now look at the first type of foreign currency derivative, currency forwards. A currency forward is a private contract between two parties to buy or sell a specific amount of foreign currency on a future date, but at a fixed exchange rate that is agreed upon today. That agreed upon rate is known as the forward rate. Now, to fully understand this, we need to first know what a spot rate is. The spot rate is the current exchange rate at which one currency can be exchanged for another right now, on the spot. It's the rate you'd get if you walked into a bank or checked a live currency converter to exchange money instantly. In contrast, the forward rate is the rate agreed upon today for a currency transaction that will happen in the future, such as 30 days, 90 days, or even a year from now. For example, suppose today's spot rate for USD INR is 85, meaning 1 US, dollar equals 85 Indian rupees. But a company expects to receive US dollars in 3 months. To protect itself from the risk that the dollar might weaken by then, the company enters into a forward contract to sell USD and receive INR at a forward rate of, say, 84.5. That way, they lock in their future exchange rate and avoid uncertainty. The difference between the spot rate and forward rate is influenced by factors like interest rate differences between the two countries, market expectations, and inflation trends. If the forward rate is higher than the spot rate, we say the currency is trading at a forward premium. If it's lower, it's trading at a forward discount. Currency forwards are very useful for companies involved in exports or imports, where payments in foreign currency are scheduled for the future. These contracts help businesses lock in rates and eliminate the risk of exchange rate fluctuations, hurting their profits. Now let's understand what it means when we say a currency is trading at a discount or a premium in the forward market. This concept is based on comparing the spot rate with the forward rate for a currency. If the spot rate is greater than the forward rate, it means the currency is expected to have a lower value in the future. In this case, we say the currency is trading at a discount in the forward market. For example, if the current spot rate of USD INR is 85, but the 3-month forward rate is 84, that means in the future, 1 US dollar will fetch fewer Indian rupees. So, from this observation, we conclude that the US dollar is trading at a discount against the Indian rupee in the forward market. On the other hand, if the spot rate is less than the forward rate, the currency is expected to increase in value in the future. In this situation, we say the currency is trading at a premium. For instance, if the current spot rate is 85 and the 3-month forward rate is 86, this means $1 will get more rupees in the future. Therefore, the dollar is considered to be at a premium in the forward market. These differences between the spot rate and the forward rate usually reflect expectations in the market about economic conditions, such as interest rate differences between countries, inflation trends, or investor sentiment. Understanding whether a currency is at a premium or discount helps companies and investors make better decisions when hedging their foreign exchange exposure using forward contracts. Now, let's learn how to calculate the percentage of forward discount or premium in foreign exchange contracts. This calculation helps us understand how much the forward exchange rate differs from the spot exchange rate, expressed as an annualized percentage. The formula is percentage of forward discount or premium equals the forward rate minus the spot rate, divided by the spot rate, multiplied by 365, then divided by the contract duration in days. Let me say that again more simply. You take the difference between the forward rate and the spot rate. Then, divide that difference by the spot rate. After that, multiply by 365 days to annualize it. Finally, divide by the number of days in the contract period. Written as an equation, it looks like this. Percentage forward discount or premium equals forward rate minus spot rate, divided by spot rate times 365 divided by contract duration. Here's what these terms mean. The forward rate is the agreed exchange rate for a currency transaction that will happen in the future. The spot rate is the current exchange rate for immediate settlement. The contract duration is the number of days until the forward contract matures. If the forward rate is higher than the spot rate, the currency is said to be trading at a forward premium. This means the currency is expected to strengthen. If the forward rate is lower than the spot rate, the currency is at a forward discount, meaning it is expected to weaken. This percentage tells businesses and investors how much extra cost or benefit they can expect from the forward contract compared to the current spot rate, adjusted to an annual basis. Let's apply the formula with a simple example to see how the percentage of forward premium or discount is calculated. Suppose we have the currency pair USD/INR. The spot rate is 60, meaning $1 equals 60 Indian rupees right now. The forward rate for 60 days is 60.199, meaning in 60 days, the agreed rate is 60.199 rupees per US dollar. Now, using the formula. Percentage of forward discount or premium equals forward rate minus spot rate divided by spot rate multiplied by 365 divided by contract duration. Let's plug in the numbers. Forward rate minus spot rate is 60.199 minus 60, which equals 0.199. Divide that by the spot rate, 60, so 0.199, divided by 60 equals approximately 0.003317. Next, multiply by 365 days to annualize. 0.003317 times 365 equals about 1.2107. Finally, divide by the contract duration, which is 60 days. 1.2107 divided by 60 equals approximately 0.02018 or 2.01%. Since the forward rate is higher than the spot rate, this means the US dollar is trading at a forward premium of about 2.01% per annum against the Indian rupee. In other words, it costs slightly more rupees to buy $1 in the future compared to now. In our example, we calculated that the US dollar is trading at a forward premium of about 2.01% per annum against the Indian rupee. But what does this mean for the Indian rupee? Since the exchange rate is expressed as USD/INR, that is the price of $1 in Indian rupees, when the dollar has a forward premium, the rupee must have a forward discount by the same percentage. This happens because the two currencies move in opposite directions relative to each other. If the dollar is expected to strengthen by 2.01%, the rupee is expected to weaken by approximately 2.01% in the forward market. So, from the perspective of the rupee, it is trading at a 2.01% forward discount against the US dollar. This relationship is reciprocal. The forward premium on one currency equals the forward discount on the other. It's important to understand this because it shows how currency values shift relative to each other, affecting international trade and investment decisions. Now let's talk about currency futures, another important tool used to manage foreign exchange risk. Currency futures are very similar to forward contracts. Both allow a buyer or seller to lock in an exchange rate today for a currency transaction that will take place at a future date. In simple terms, it's like making a deal today to buy or sell a currency at a fixed price in the future, to protect against fluctuations in exchange rates. But here's the key difference. Forwards are private agreements made between two parties, usually through banks or financial institutions. Whereas currency futures are standardized contracts that are traded on organized exchanges, like the Chicago Mercantile Exchange, or CME. This difference changes a lot of things. Let's break it down. First, because futures are traded on exchanges, the terms of the contract, like the size of the contract, the settlement date, and the type of currency, are standardized. That means you can't customize the contract to suit your exact needs, like you can with forwards. But the advantage is transparency, liquidity, and regulation. Second, currency futures require something called margin deposits. Both the buyer and the seller have to deposit a small amount of money with the exchange, called the initial margin. Each day, the value of the contract is adjusted based on the market. This is known as mark-to-market. If the value moves against your position, you may have to deposit more money, known as a margin call. Third, currency futures are more liquid. Because they're traded on exchanges, there are many buyers and sellers. You can enter or exit a futures position at any time before the contract expires, just like you would trade a stock. Also, since exchanges act as intermediaries between buyers and sellers, there's almost no counterparty risk. This is one of the biggest advantages over forward contracts, where the risk of default by the other party can be a concern. Let's summarize. Currency futures are used to hedge or speculate on future currency movements, just like forwards. But unlike forwards, futures are traded publicly, are regulated, require margin deposits, and are settled daily through the exchange. This makes them a great tool for traders and institutions who need flexibility, liquidity, and a secure trading environment, even though they may not be as flexible as forwards for customizing contracts. Now let's explore another important tool used for managing foreign exchange risk, called currency swaps. A currency swap is a financial arrangement between two parties to exchange principal and interest payments in two different currencies over a set period of time. This is commonly used by companies that operate internationally, especially when they need access to foreign currencies for business operations, or when they want to hedge against currency fluctuations. There are two major types of currency swaps. One, foreign exchange swap. A foreign exchange swap is typically a short-term agreement where two parties simultaneously agree to buy and sell a certain amount of currency, one at the spot rate and the other at a forward rate. This means the company will exchange currencies now and then reverse the exchange at a fixed rate on a future date. But here's an important point. Multinational companies often use foreign exchange swaps when they have forex reserves held in different countries. By using these reserves across their global operations, they can effectively hedge exchange rate risk without raising new capital or taking on fresh debt. Let's take a simple example. A company might sell US dollars today and receive euros at the spot rate. At the same time, they agree to buy back those dollars after 60 days at a predetermined forward rate. This way, they cover short-term currency needs without being exposed to exchange rate fluctuations. 2. Foreign currency swap. A foreign currency swap, on the other hand, is a long-term contract, often lasting several years. Here, companies exchange not only currency amounts, but also interest payments over the life of the contract. At the start of the swap, the companies exchange principal amounts in different currencies. During the contract, they keep exchanging interest payments, and at the end, they reverse the principal exchange. Now here's the real-world use. Companies exchange foreign transactions with another company to access the currency they need. For example, a US company that has revenue in dollars but needs to make payments in euros might enter into a currency swap with a European company that has the opposite need. By doing this, both companies help each other meet their currency requirements without going through expensive international borrowing or exposing themselves to exchange rate risk. Let's now look at a practical example to understand how a currency swap can help a company manage foreign exchange risk effectively. Here's the situation. A US company has 500,000 euros in a German bank account and 680,000 US dollars in its US bank account. On June 31st, the company is required to make a payment of 500,000 euros to a German vendor. But there's a challenge. The 500,000 euros in the German bank are not available until December 1st. To manage this situation, the company decides to use the US dollars available in the US bank to make the payment to the vendor. At the same time, the company enters into a 6-month forward contract, agreeing to sell euros and receive dollars at a forward rate of 1.4 euros per US dollar. The spot rate at the time is 1.35 euros per US dollar. Let's go step by step and calculate the outcome. Step 1. Convert dollars to euros at the spot rate. To pay 500,000 euros today, the company needs to calculate how many dollars are required at the spot rate of 1.35 euros per dollar. So the amount of dollars required equals 500,000 euros multiplied by 1.35, which equals $675,000. This means the company will use $675,000 from its US bank account to buy euros and make the payment. Step 2. Find the remaining dollar balance. The company originally had $680,000 in the US bank. After using $675,000 to pay the vendor, the remaining balance equals $680,000 minus $675,000, which equals $5,000. So the US bank account now has $5,000 left. Step 3. Use of forward contract on December 1st. Now we move forward to December 1st. On this date, the original 500,000 euros in the German bank finally become available. The company uses the forward contract it signed earlier, which allows it to sell euros and receive dollars at a fixed rate of 1.4 euros per dollar. So the amount of dollars received equals 500,000 euros multiplied by 1.4, which equals $700,000. So, on December 1st, the company receives $700,000 by converting its euros using the forward rate. Step 4. Calculate the profit. Now let's calculate the profit earned through this currency swap strategy. The company originally used $675,000 in June to make the payment. Now it receives $700,000 on December 1st. So the profit equals $700,000 minus $620,000, which equals $80,000. This means the company gains $80,000 from this swap transaction. Step 5. Final U.S. bank balance. Now let's calculate the final balance in the U.S. bank account. The company had $5,000 remaining after the initial payment. Now it adds the $700,000 received from the forward contract. So the final U.S. bank balance equals $700,000 plus $5,000, which equals $705,000. Let's summarize the entire transaction. The company had to pay 500,000 euros on June 31st. It used its US dollars to make the payment by converting at the spot rate of 1.35. It protected its euro balance using a forward contract at 1.4, which it used on December 1st. As a result, it received more dollars than it had originally spent, leading to a profit of $80,000. The final balance in the US bank account became $705,000. This is a great example of how currency swaps help companies meet obligations on time, manage exchange rate risk, and sometimes even generate profits through careful financial planning. Now let's look at another important tool used to hedge foreign exchange risk, and that is currency options. A currency option is a financial contract that gives the holder the right, but not the obligation, to buy or sell a foreign currency at a predetermined exchange rate, known as the strike price, on or before a specific expiration date. These contracts are commonly used by businesses and investors to protect against unfavorable currency movements, while still allowing them to benefit if the exchange rate moves in their favor. Currency options are written on foreign currencies and are available through major exchanges, as well as in the over-the-counter market. There are two main types of currency options. One foreign currency call option. A foreign currency call option gives the holder the right to buy a specific amount of foreign currency at the strike price. For example, if a company in the US is planning to pay in euros 3 months from now, it may buy a call option on euros. This way, if the euro strengthens against the dollar, the company is protected because it can still buy euros at the lower strike price. If the exchange rate becomes favorable, the company can simply choose not to exercise the option and buy euros at the market rate instead. So the call option acts as an insurance policy against rising foreign currency costs. 2. Foreign currency put option. A foreign currency put option gives the holder the right to sell a specific amount of foreign currency at the strike price. This is useful for companies that expect to receive payments in foreign currency. For example, a European company that expects to receive US dollars in the future might buy a put option on dollars. If the dollar weakens, the company can still sell those dollars at the higher strike price defined in the option. If the exchange rate is better than the strike price, the company can ignore the option and sell at the market rate. So, just like the call option, the put option provides downside protection while keeping the upside open. Now let's take a deeper look at how foreign exchange risk is created based on the company's position, whether it's buying or selling a foreign currency. This is important because the direction of the risk changes depending on whether the company is dealing with incoming or outgoing payments. Let's break this down clearly. Situation 1. The company is selling foreign currency. Imagine a company that operates in a foreign country. For example, an Indian company exporting goods to the United States. The company will receive US dollars in the future, but it needs to convert those dollars into Indian rupees, which is its domestic currency. Here, the company is essentially selling foreign currency. In this case, selling dollars to buy rupees. So what is the risk? The risk is that the foreign currency, the US dollar, might depreciate. If the dollar becomes weaker, the company will receive fewer rupees when it converts the dollars. This will reduce the company's revenue in terms of domestic currency. So when a company is selling foreign currency, the risk is depreciation of that foreign currency. Situation 2. The company is buying foreign currency. Now let's take the opposite case. Suppose a company needs to import goods from another country and pay in foreign currency. This means it must buy foreign currency, for example, buy US dollars using Indian rupees. In this case, the company is paying foreign currency, and it is buying that currency using its domestic currency. So what is the risk here? The risk is that the domestic currency might depreciate, or the foreign currency might appreciate. If the US dollar becomes stronger, or the Indian rupee becomes weaker, the company will need more rupees to buy the same amount of dollars. This increases the company's cost of imports. So, when a company is buying foreign currency, the risk is appreciation of the foreign currency or depreciation of the domestic currency. To summarize, when a company is selling foreign currency, the risk is that the foreign currency might depreciate. This reduces the value of the payment when converted. When a company is buying foreign currency, the risk is that the foreign currency might appreciate. This increases the cost of the payment in domestic currency. Understanding this relationship helps companies choose the right hedging strategy, whether it's a forward contract, a futures contract, or a currency option. Dear students, to fully understand the concepts of forwards, futures, swaps, and options, we strongly recommend watching our episode 17 on derivatives, where we explain each instrument in detail with practical examples. You'll find the link above or in the description box below. Make sure to watch it for a complete understanding before moving on. It will make this topic much easier to apply in real-world exam questions and professional scenarios. Now let's understand the modes of international payment, a key concept in international finance that deals with how businesses pay and receive money across borders. When companies or individuals engage in international trade or investment, they need secure, reliable, and efficient ways to transfer funds between countries. Because cross-border payments involve different currencies, banking systems, and regulations, choosing the right mode of payment is crucial to avoid delays, reduce risks, and manage costs effectively. In international trading, one party cannot fully trust the other party right away. So, how do buyers and sellers manage payments and shipments safely? Here's the answer. There are two banks involved. One bank represents the supplier or seller, and the other bank represents the customer or buyer. These two banks communicate and agree on how the payment and settlement will happen. Now, the seller ships the goods to the buyer and prepares important documents such as the invoice, which is the bill showing what goods were sold and how much money is owed. The bill of lading, which is a receipt from the shipping company confirming that the goods have been shipped. Insurance papers and other necessary trade documents. These documents are sent through the seller's bank to the buyer's bank. The buyer needs these documents to receive the goods at the port. But the banks make sure the buyer either pays or accepts to pay before handing over these documents. This process is called documentary draft collection. Now, there are two types of payment requests in this system. A sight draft. With a sight draft, the buyer must pay immediately when the documents arrive. The buyer can only get the goods after making the payment. B, time draft. With a time draft, the buyer can pay after a certain time period, which is agreed upon in advance. The buyer promises to pay later, but still must accept the draft to get the documents and the goods. So, this method helps protect both the buyer and the seller. The seller gets paid or promised payment before the buyer receives the goods, and the buyer can be sure the goods have been shipped before paying. Let's now look at the second mode of international payment, called the open account method. In an open account transaction, the seller ships the goods first and the buyer pays later, usually after 30, 60, or even 90 days. There are no formal guarantees, no bank documents, and no third-party security involved. The sale is made entirely on trust. This method is normally used only when both parties know each other well and have a long-term business relationship. The seller believes the buyer will pay on time based on past experience. Now let's look at the third mode of international payment, called prepayment. In this method, the importer pays in advance, before the goods or services are delivered. That means the buyer sends the money first, and then the seller ships the goods. This method gives the maximum safety to the seller, because they receive the payment before doing anything. But what about the buyer? For the buyer, this method involves high risk. If the seller fails to ship the goods or delivers poor quality products, the buyer may lose the money, and there may be no easy way to recover it, especially in international trade. So when is prepayment used? It's usually used when the seller is not willing to take any risk. The buyer is new or has no credit history. The goods are customized or made to order. The seller is in a strong bargaining position. To summarize, prepayment means the buyer pays first and the seller delivers later. It's safe for the seller, but risky for the buyer. So it's only used in special cases where the buyer agrees to these terms. Let's now talk about another unique method of international payment called countertrade, and more specifically, barter. Barter is one of the oldest forms of trade. It is a type of countertrade where no money is used. Instead, the two parties exchange goods or services directly. One item is traded for another. For example, a country may trade oil in exchange for food supplies, or a company may provide machinery in return for raw materials. This method has been used for thousands of years, especially in older economies or during times when currency systems were not stable. Even today, it is occasionally used in international trade, mostly when there is a shortage of foreign currency, countries face trade restrictions or sanctions, or when dealing with economies that do not have access to international banking, but barter has some challenges. The biggest problem is that both parties must agree on the value of goods being exchanged. It can be very difficult to find products of equal value, and negotiation takes time. Because of this, barter is not very common in modern global trade, but it still exists in some special cases. To summarize, countertrade or barter is the exchange of goods or services without using money. In international trade, trust and payment security are major concerns. To reduce the risk for both buyers and sellers, banks provide certain financial securities that support the transaction and guarantee payment when conditions are met. Let's look at two commonly used securities in global trade. 1. Commercial letter of credit, often called LOC. A letter of credit is a document issued by the buyer's bank. It promises that the bank will make the payment to the seller as long as the seller provides the required documents, like the invoice, shipping proof, and other agreed terms. So, the letter of credit acts as a guarantee from the buyer's bank. It gives confidence to the seller that the buyer is financially sound and the bank will step in to make the payment if everything is done correctly. This allows the seller to safely proceed with the shipment. Letters of credit are one of the safest and most commonly used payment tools in international trade. 2. Banker's acceptance. A banker's acceptance is a special type of time draft. Here's how it works. The buyer, or importer, creates a draft promising to pay the seller at a future date. This draft is then accepted by the buyer's bank, making it a formal obligation. Once the bank accepts it, the seller can either wait for the payment at the due date or sell the accepted draft in the money market to get the cash earlier. This means a banker's acceptance can be used like a financial instrument, almost like a post-dated check that is backed by a reliable bank. It gives confidence to the seller that the payment is secure and can even be turned into cash before the due date. To summarize, a letter of credit guarantees payment if the seller meets the agreed conditions. A banker's acceptance is a bank-backed promise to pay in the future, which the seller can use to raise funds immediately. Both instruments play a vital role in building trust and ensuring smooth transactions in international trade. Now let's learn about two types of international financing tools that help exporters manage their cash flow and reduce the risk of not getting paid on time. These are forfeiting and cross-border factoring. We'll understand what they mean and how they work in international trade. Let's begin with forfeiting. In forfeiting, the importer arranges a short-term loan and the exporter receives payment up front. Here's how it works. The importer issues something called a promissory note. This is simply a written promise to pay a fixed amount of money to the exporter at a future date. Now, instead of waiting, the exporter takes these promissory notes and sells them to a financial institution, which we call a forfeiter. The forfeiter then gives the exporter the full payment, minus a small fee or discount. Later, the forfeiter collects the money directly from the importer. So, the exporter gets their money quickly and does not have to worry about whether the importer pays on time or not. This method is especially useful when the exporter does not want to take any credit risk or wait for several months to receive payment. Next, let's understand cross-border factoring. In this method, the exporter also wants to get paid faster, but instead of promissory notes, the exporter sells their invoices or receivables to a company called a factor. But here's the interesting part. The factor is located in the importer's country. The process goes like this. The exporter sells goods to a foreign buyer and issues an invoice. Now, instead of waiting for the buyer to pay after 30 or 60 days, the exporter sells that invoice to the factor. The factor pays most of the invoice value to the exporter immediately, and later collects the full payment from the buyer. This way, the exporter gets instant cash and the collection work is handled by the factor. So, in both forfeiting and cross-border factoring, the exporter does not have to wait or chase the buyer for money. They receive payment quickly and avoid risks related to delayed or missed payments. The main difference is, forfeiting involves promissory notes and is more suitable for larger deals, while factoring is based on invoices and is used more often for smaller, short-term sales. Now let's understand the different types of exchange rate systems used by countries around the world. An exchange rate system is the method a country uses to manage the value of its currency in relation to other currencies. It affects how money is exchanged, how trade happens, and how governments control inflation and foreign investment. There are 4 major types of exchange rate systems. Let's start with the first one, floating exchange rate system. In a floating system, the value of a country's currency is determined entirely by the demand and supply in the foreign exchange market. There is no fixed rate set by the government or central bank. If more people want to buy the currency, its value rises. If fewer people want it, the value falls. This system is commonly used in large, stable economies. For example, the United States, United Kingdom, Canada, Japan, and countries in the European Union like Germany and France use a floating exchange rate system. It gives flexibility but can also lead to currency volatility. Next is the fixed exchange rate system. In a fixed system, the country's government or central bank sets a specific rate for its currency and maintains that rate against another major currency, usually the US dollar or the euro. To keep this fixed rate, the central bank actively buys and sells currencies in the foreign exchange market. A good example is Saudi Arabia, which has kept its currency fixed at about 3.75 Saudi riyals per US dollar for many years. Another example is the Hong Kong dollar, which is pegged to the US dollar at around 7.80 HKD per USD. This system brings stability, especially for countries that rely on imports or exports, but it reduces flexibility. The third type is the managed float system. Here, the exchange rate is mostly determined by market forces, like in a floating system, but the central bank sometimes intervenes. This means, if the currency moves too far up or down, the central bank will buy or sell currency to bring it back within an acceptable range. India is a good example of a managed float system. The value of the Indian rupee is mostly market-driven, but the Reserve Bank of India intervenes when the rupee becomes too strong or too weak. China also follows a managed float, allowing the yuan to move within a specific band. This system offers a balance between flexibility and control. The last system is the pegged exchange rate system. In this system, a country pegs its currency to another major currency, usually the US dollar, but does not intervene every day like in a strict fixed system. The exchange rate is kept stable, but there's some room for movement. This system is usually used by small or developing countries whose currency is not actively traded worldwide. Examples include the United Arab Emirates, Qatar, Bahrain, and Kuwait, all of which peg their currencies to the US dollar. Another example is Denmark, where the Danish krone is pegged to the euro under a system called ERM2, which allows a small band of fluctuation. The pegged system gives these countries stability and makes international trade easier. So to summarize, a floating system is based on demand and supply. A fixed system is tightly controlled by the government. A managed float is a mix of both, mostly free but with occasional central bank action. And a pegged system links a country's currency to a stronger currency to gain stability. Before we wind up, let's quickly look back at what we covered in this episode. First, we learned about foreign exchange risk and how companies can manage it through different strategies, including natural hedges, operational hedges, international financing, and the use of foreign currency derivatives like forwards, futures, swaps, and options. Second, we explored the modes of international payment, such as documentary drafts, open account, prepayment, and countertrade or barter, understanding how international buyers and sellers transfer money securely. Third, we discussed the securities used in international import and export transactions, including the commercial letter of credit and banker's acceptance, which help reduce payment risk in cross-border trade. Fourth, we understood the types of international finances, such as forfeiting and cross-border factoring, which help exporters improve cash flow and manage credit risk. And finally, we studied the different exchange rate systems, including the floating system, fixed system, managed float, and pegged system, along with examples of countries using each. Thank you for watching this episode. Make sure you go back and revise the key points, and most importantly, practice your questions regularly. Keep learning, stay focused, and I'll see you in the next episode.